likely pulls the Fed's reaction function forward, and I would expect to see a little bit more of a dovish conversation later in the year. But that's just not something that we're going to know in the first quarter of this year.
So we just don't know, right? So would you love to kind of fast forward, Liz, like 6 months from now? Do you feel like there'll be more clarity?
Yes, I think there'll be more clarity at the end of the first quarter. And the way that the market is pricing it in right now, we're going to see a 25 basis point hike in February and another one in March, and that might be it. So we may know by the end of the first quarter that they're done hiking rates. And then we'll just move to the question of, okay, how long do they keep rates this high? And that's really more along the lines of what does the economy look like in the meantime? And are capital markets functioning in a healthy manner? Now, when I want to be really clear here, capital markets functioning in a healthy manner doesn't mean always going up. They can go down. We can continue to see drawdowns, and we can see a drawdown beyond 30% if we're going into a recession. The Fed would not likely characterize that as an unhealthy thing. So I don't want investors to get kind of twisted with the idea that, oh my gosh, if the market goes down, that means they'll pivot. That is not at all the case.
So wait, do you not think, Liz, then that the recession is already factored in the markets? You don't?
I do not think it's already factored in. I think we've gotten close. So the biggest drawdown that we saw from a peak to a trough in 2022 was 25%. That's pretty mild when you look at the context of prior recessionary drawdowns. Usually a recessionary drawdown is beyond 30% and actually on average beyond 40%. We may not get down that far, but I don't think it's all entirely priced in yet. And I think there are a decent amount of investors still hoping for that soft landing.
Right.
The soft landing is maybe what's priced in.
And yet some individual names you could argue maybe could be in a recession, a pretty deep recession, right?
Oh,
if you think peak to trough. So are they outliers, exceptional cases? How do you think about that?
They're not necessarily outliers, and I can't speak to specific names, but if you just look at basically the industry groups, the sectors that have been hit hardest that are beyond that 30 to 40% drawdown, those are the ones that were most sensitive to an environment like this, or the ones that enjoyed so much of the upside before this environment began. So there was a lot more to give back, and there was a lot more to bring back in balance. Also, this has affected different parts of the economy at different speeds. So right now, we're sort of sitting on this waiting game of when will it affect the consumer and when will it affect the labor market. I think actually once the labor market gets affected is when the consumer pulls back meaningfully in their spending, and then we start to see that in the data. But because it's happened at different speeds, it's also happened at different speeds in the market, and different sectors have taken it on the chin more than others.
Is there any indication to you that we're getting any closer to a time when this will affect the labor market? I mean, look at the JOLTS number that we got this morning. Another strong report for employees right now. I mean, people who are looking for a job. There are, 1.7 jobs for every person looking for one.
Yeah, the JOLTS data certainly has not shown any meaningful weakness yet, but I would point out that that JOLTS number was from November. So when we start to get the December data in labor, I think that that will be the first month where we say, you know what, things changed a little bit. When we have to look back on it, right? This might be in May that we're looking back on December data and saying that was the month that it changed. But I do think we're going to start to see weakness. And the reason I say that is because we heard about a lot of those tech layoffs, but technology really doesn't make up that big of a portion of the labor force. In December, we started to hear about layoffs in other sectors. It bled into some of the big banks. We heard about it across other sectors of the economy, and that's when it starts to hit the actual data, the monthly data that we hear from jobs. And also, the continuing claims information that we've gotten has shown a pretty decidedly upward move in claims that's been consistent over the last few weeks. So continuing claims is people that have been claiming jobless for more than 2 weeks. So once that starts to bake into the data too, we'll see it in the monthly numbers.
Interesting year. I feel like it could be another tricky year. Having said that, what do you think investors should watch more closely that's going to be more accurate and kind of where we are and where we're going, the bond market or the equity market? And just got about 30 seconds.
Well, if you read my outlook or anything that I've written in the last 30 days, I think the bond market has this right. But when I say bond market, I mean the Treasury market. And the Treasury market is calling for a recession. I think the credit market has yet to really get that message. So we'll probably see spreads blow out a little bit more.
All right, going to leave it on that note. Hey, listen, thank you so much. Liz Young, Happy New Year. She's head of investment strategy over at SoFi Technologies, the online personal financial services company, joining us, as you saw, via Zoom for those who are watching on YouTube and Bloomberg Quick Take. She's there in New York City. Right now, that 10-year note with a yield of 3.68, 2-year note, the shorter end of the yield curve at 4.35. And of course, we've got a jobs report on Friday.
Holding on to gains on the three major indices we follow closely, the S&P and the NASDAQ, all higher right now.
It is 3:53 on Wall Street. I'm Charlie Pellet with today's company headlines. Chevron CEO Mike Wirth is pushing back on claims by President Biden that big oil's record profits are being made on the back of the war in Ukraine and at the expense of the American people. Speaking on the David Rubenstein Show peer-to-peer conversations, Wirth also addressed changes in technology, allowing Chevron to pump more oil in places where it previously could not.
What has really changed in the last decade, David, is what we see in the U.S. in the Permian Basin, but also in some other parts of this country and in other countries now, is the ability to produce oil and gas from rock that is very, very dense, very hard, and historically has not been very productive. But with directional drilling and the ability to fracture these formations now, we're seeing the ability to produce from areas that we couldn't before and at prices that are lower than some of these very complex, difficult projects.
And you can hear the full conversation tonight, 9 o'clock on Bloomberg Television. Chevron shares, they are lower by 1.3%. ExxonMobil down 0.2%. BP, the ADR is down 1.8%. EOG Resources down 0.1%. Pioneer Natural higher now by 1.1%. Verizon Communications expects to cut capital spending by 23% in 2024 as the company completes its major 5G network. Verizon up now by 2.3%. Those are our company stories. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week. Yes, it's a Fed Wednesday. We got those FOMC minutes. The Fed warning everybody, even if financial, conditions start to ease, that doesn't mean you should get ahead of yourself because guess what? The Fed's going to continue tightening.
You've heard lower for longer.
Yes, I have.
What about higher for longer?
There you go.
A big part of what I've been thinking about, Carol, and I'll probably say this again when we're with our friends at Bloomberg
You're just
TV,
like Jay
Katie
Powell and
Romaine.
company.
It's just this normalization that, if you think about what we saw post-financial crisis when it comes to interest rates, that's not normal.
No.
And the world needs to adapt.
We've been spoiled. We've had a really easy money, low rate environment for a
Hope
long
you bought
time.
your house then.
Yeah, exactly. Sorry, everybody who's kind of stuck. Having said that, interesting story. Manhattan home prices, though, slipping 5.5% in the first decline since mid-2020. We know prices have stayed higher, but we're starting to see a change of tune.
Yeah, co-ops and condos traded for a median of $1.1 million in the fourth quarter. That's a 5.5% drop from the same period in 2021. That's according to the appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. It was the first year-over-year decrease in prices since sales stalled at the beginning of the pandemic, which, as a reminder, was the second quarter of 2020. I always like to say, even though these stories always are among the most read on the Bloomberg terminal because they're so important for our audience, the Manhattan market, Carol, is a unique beast. It's a bubble, as Pierre DeBoss reminded us just last week.
Yeah, that's a really good point. If you missed that conversation, do check out our podcast feed. You can find that at Bloomberg.com or wherever you download your podcast. Having said that, even though Manhattan home prices are coming down, first decline, as Tim mentioned, and we talked about since mid-2020, market is still stronger than it was 3 years ago. So a little perspective. Some other perspective, there's a new hedge fund out there soaring 163%, betting everything is going down.
And they did pretty well. Veteran trader's well-timed bet on the end of easy money has achieved triple-digit returns in his new hedge fund's first full year. After running Eagle View Capital Management as a fund of funds for 16 years, the New York-based founder Neil Berger decided to add his own fund to the mix. The Contrarian Macro Fund launched initially, Carol, with partner capital in April 2021 to load up on bets, even as policymakers were describing inflation as transitory.
Yeah, kind of interesting. So this Eagles View Capital launched fund to catch the market downturn. Fund is now betting on a continued bear market and a tightening by the Bank of Japan. So listen, just some details, but check out more of those stories, the full complete stories. You can find that at Bloomberg.com. Carol Massar, Tim Stenivek, we're getting ready to count down the market close. Bloomberg's Beyond the Bell, starting right now.
Down to the closing.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to the closing bell. And here to help take us Beyond the Bell. It's a global simulcast with Carol Massar and Tim Stenivek. We welcome our audiences across Bloomberg Television, radio, Quick Take, as well as on YouTube. Carol, an interesting day here. We started off strong. We kind of faded a little bit in the later hours, but now getting a little bit of a bid here as we're just about a minute or so away from those bells.
Remember all that volatility we had last year? It feels like I've seen this movie before because we certainly saw a lot of volatility in the trade today. Having said that, if you're looking for some outperformance, I think, Tim, you talked about this earlier, some of those semiconductor names, right? We talked about about that big story, that Bloomberg exclusive about China maybe paring back some of its mega investments in the chip space. Well, the stock's definitely showing some outperformance today, just pulling it up on my Bloomberg, up about 2.6% here.
We just had a great chat with Liz Young, head of investment strategy over at SoFi, and she said that, you know, the markets right now are only pricing in a soft landing. So if we look at historical comparisons to how markets have done during recessions, if we do get some sort of recession, even if it is a soft recession or a recession that's not very deep, a shallow recession, she doesn't think it's all entirely priced in right now. We could see lower on the S&P.
Well, that's the big question. I mean, what does that pricing look like? The S&P 500 off, what, 19% over the past year? How much longer until we actually fully have that factored in? It's an open question.
Yeah, she thought none of it, right, factored in.
Exactly.
Yeah.
And reminding us that historically, I mean, it could be a drawdown as much as 40% during a recession.
Yeah, but this gets back, of course, I guess, to the big issue with what we saw in the Fed minutes today, the idea that the Fed now is also concerned here about some of the market expectations, the idea that folks are pricing in that soft landing, and more importantly, that Fed pivot in the second half of the year. And those minutes made clear that the Fed is maybe a little bit uncomfortable with that, at least as of the mid-December. Closing bells here in New York, a Dow Jones Industrial Average going to finish the day higher by 0.4%. The S&P higher by about 0.8%, while the NASDAQ higher by about 0.7%. The outperformer on the day that belongs to some of the cyclical names, Dow Transport's up about 1.7%, and the Russell 2000, Carol, up 1.2%.
Yeah, what's interesting too, Romain, just in these last few minutes of trading, we did see investors coming in, pushing those indexes a little bit higher, as I said, in the last few minutes of trading. Having said that, and maybe those hawkish comments by the Fed, you might put a damper. But Katie, if you look at it, most of the names in the S&P 500 actually posted gains today.
It was the same story on the industry groups as well. Up at the top, you have autos. A lot of that is Tesla. I was off last week. I know you guys were all over that story. It's hard to follow. But in any case, Tesla is higher today. The industry group higher as well. And then, like Carol mentioned, I mean, you have semis just ripping today out of that Bloomberg reporting out of China. So a sector to watch. You go down to the bottom of the list. We have software at the bottom of the pack, down about 1%. Microsoft is the big loser there, Carol.
Katie, did you say semis are ripped?
No, I said they're ripping. They ripped today.
Just checking, just checking. All right, let's get to some of the gainers. You mentioned Tesla. Big story last year, continues to be a big story here in the new year. But go figure, 12% drop yesterday, but gaining 5% in today's session. Kathy Woodner, ARK Investment Management, she bought big time on yesterday's drop, continuing to buy shares. She's been doing so, I should say, really since the company, Tesla has really been paring back a lot of its gains. So she did a lot of buying in the last few months of last year as well. She bought more than 176,000 shares in that first U.S. trading day of the year. That's according to ARK's daily data. But they've acquired more than 938,000 shares of Tesla since October 3rd, when the stock really started to do a dip to the downside. Warner Brothers Discovery, this was top in the S&P 500 and NASDAQ 100, up almost 9% in today's session. Stock down still about 60% in the past 12 months. Again, I'm scratching my head because it did get a price target cut to 16 from 18 over at Macquarie, and you've got the stock rallying on the news. I don't get it. They did maintain their outperform, so we'll look for some more news maybe on Warner Brothers Discovery. Salesforce, Romain, you talked about this earlier, up about 3.6% here.
Yeah.
Job cuts, talking about 10% of a cut to its workforce and reducing its real estate holdings. But again, I would say that investors say, hey, you're being smart. Maybe it's a downturn or it's a tougher environment this year, so how do you cut costs and Salesforce coming out?
How many strategists have we heard from who basically said that cost cutting, belt tightening, that really is going to be what drives value for some of these names. So if these companies can get behind it, maybe investors will warm.
I go back to this idea of normalization. I mean, so many people were hired at these companies during the pandemic. Look what Meta Platforms had to do just in the last couple of months. So are we going to start to see even more companies belt tightening and, you know, getting rid of some of those employees who they did hire over the last couple of years? One company not doing so well today, Microsoft shares down 4.4% on the day. It's the biggest one-day drop since October 26. Remain now trading at levels last seen in November. This all because of a downgrade from UBS over concerns about Microsoft Azure. UBS writing that Azure is, quote, entering a steep growth deceleration that could prove to be worse in fiscal 23 and 24 than investors are modeling. Pfizer also finishing the day down by 2.2%.
And I just want to, I just point out, because I was actually kind of shocked by that downgrade, because I always thought Azure and really just cloud computing was kind of impenetrable, and the growth we know has been there. But I think it's interesting. if that analyst is right, and some of the other analysts are also predicting this, they're actually seeing one of the first quarterly declines in revenue potentially for Microsoft for the second quarter of the year, the fiscal second quarter, I should say, of the year. So that'll be interesting to see whether that actually materializes.
Yeah, it's interesting. In the note, they wrote that the business may be slowing due to maturation, not just because of a tough macro environment. So I expect to see similar notes across the environment. I mean, I'm looking at you, Amazon, for Amazon Web Services.
Actually, I just looked on that. I just want to make sure I get this right. So I just looked at the term. So the expectation is for 2% growth on the headline revenue numbers. But remember, they were in double digits, pretty much going back, I don't know, several years here, basically at like 14 to 20%.
All right, thanks for that, Romaine. Pfizer down 2.2% on the day today. B of A, again, another downgrade. All three of my decliners are due to downgrades. B of A seeing uncertainty over the magnitude of the revenue decline from Paxlovid in 2023 as well as the vaccine.
Can I just stop you again, though? But I mean, your comment, I think, is interesting because we talk about market sentiment. There was a slew of downgrades today, probably some of the most that I've seen in quite some time. And we talked so much late last year how analysts really hadn't revised down any of their expectations.
Right, it's like they're catching up right now.
Yeah, it's interesting, yeah.
Honeywell, how about this? A double downgrade on Honeywell today. Cut to sell from buy. Price target lowered from $220 to $193. Another one from UBS. Shares finishing lower on the day as well.
Absolutely. And just a quick check on yields here. Relatively modest, but you did see buying once again here. So a two-day rally, if you will, in the bond space here. Nevertheless, the yield move in and of itself modest, about 5 basis points
surprised,
on the longer end of the curve.
Romaine, considering that what the Fed minutes had to say, pretty hawkish, that we didn't see some bigger moves when it comes to the Treasury trade?
I think so, though. I mean,
the dollar? I don't know. Like some
I think so,
different
but
things
when we talked to Kelsey Barrow over at JP Morgan Asset Management, a couple other folks, they seem to be of the mind that there is a real buying opportunity here right now for fixed income. Even if you do believe a recession is coming, even if you do believe the Fed is going to stay at 5% or longer, they are finding value right now, and I think maybe that explains at least some of the moves we've seen over the last couple of days.
But still staying higher quality, really in the investment grade market, not yet ready to step into junk as we just continue to talk about the most talked about recession that could be coming, what that means for some of those riskier credits. It seems like
Is this the most talked about recession?
I mean, it feels the most talked about recession in my time as a journalist, for sure.
Oh, okay.
I don't know what was the most talked about recession. I'm still curious if this is going to be a shallow one and that we're going to be through it before we even realize it and, you know, kind of off and running. I guess it's hard to say. I do feel like everybody is discounting almost the first quarter. You know, do we get the Fed moves all done, the final rate increases done by that first quarter, and then do we move on and start to think about the second half?
I'll go back to the labor market and the signs that we continue to get. I mean, the jobs are coming on Friday, Romaine, the most recent month
Do you
for
trust all
November,
that labor
for
data?
December. Of course I trust it. But, you know, I brought this up with Liz Young earlier, and she said, hey, November JOLTS data that we got today, just wait until we see December. She's not very optimistic about it, but I still think that we're seeing so much, you know, such a tight labor market that it's hard to say we're in a recession.
And the other problem, too, though, is I mean, how reliable is the data? When you consider how volatile some of the data has been, I mean, can you really draw a trend line? You know what I mean?
It's not just one data point, though. That's why, you know, we're using
But that's the problem with the Fed, though. I mean, if you get 2 or 3 months or something in a row of something, can they trust that? Can they trust that that is the trend?
They're saying they're not going to.
If we can't trust the NFP data, that really opens up a lot of existential questions. But I mean, it does get back to what we're seeing in the headlines versus what we're seeing in the data. When we think again about Salesforce today, another 10% workforce cut. I mean, we've been seeing just headline after headline for months now that hasn't been showing up in the data. We know there's still a lot of openings. When that actually starts to tilt and actually show up in some of these numbers, maybe, I don't know, is it too late for the Fed?
Well, and you know, the Microsoft and Salesforce are interesting, right? They really benefited, right, from the pivot to work from home during the pandemic, kind of all in on that. And so are we just seeing, again, I think, Tim, you were mentioning this, is this just kind of going back to normal, what we're seeing in a reset of the businesses, or is there something more problematic about the economic outlook going on?
To Katie's point, I think it was Lisa Abramowitz who said it on Surveillance last week about the idea of some of these layoffs not showing up yet in the numbers. Somebody said recently, you know, a lot of these employees are getting severance packages. So maybe they're not filing for unemployment. So there might be some sort of lag effect, a long and variable lag, until we start to see those show up in
I've heard that
payroll
before,
numbers.
long and variable lag.
I got that in there.
Well, the Fed, okay, all right. Are
You're
we getting a
good
pivot?
students of Mr. Powell.
Here's the question. What comes first? Do we get a Fed pivot or do we get a new Speaker of the House?
New Speaker of the House, I think. That's my own prediction.
We'll check back.
If we don't have a Speaker of the House,
That's a great question. I think we need a Twitter poll on that one.
I'm pretty confident in my answer here, guys.
All right, guys, we got to do a wrap here. That will do it.
Jay Powell could be Speaker of the House. You think he can get a majority vote?
When worlds collide.
I'm going to cue crickets again on that one. All right, that's a wrap for our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Quick Take. We do it all beyond the bell. We'll see you again, same time, same place tomorrow. As we went round and round with our TV colleagues, and you feel like we hear that from a lot of guests. But one thing is, I feel like certain is people want to go out there and continue to experience the world. And that means getting on a plane, getting in a car, probably checking into a hotel and traveling.
Yeah, well, last fall, the survey from the Goldman Sachs-backed booking and fintech startup Hopper said that the 2022 holiday season would be the costliest and busiest yet. Carol, we've covered over the last week the trials of what we saw at airports because of the Southwest issues, which seem to be resolved now. But what about at hotels, and how did the last few weeks shape up for the quarter? We're very pleased to have with us right now John Murray, President and CEO of Sonesta International Hotels Corporation. Sonesta is the 8th largest hotel company in the U.S. They've got about 1,200 locations in 8 countries, brands that range from the Royal to Simply Suites. John joins us via Zoom from Newton, Massachusetts this afternoon. John, how are you? Happy New Year.
Happy New Year to you, too. I'm doing well. Thank you for having me on your program.
So how did the last quarter finish up for you guys in terms of expectations, what you saw from bookings, what you saw from consumers? Give us a wrap.
You know, December itself compared to last year was up significantly. It was up over 25%. But you have to remember that December of last year had some COVID impacts from some of the variants that spiked up. If you compare it back to 2019, which seems to be what most of the people in the industry do today, we were about flat. Revenues were flat because occupancies dropped a little bit, largely, I think, driven by some of the things you talked about with weather disruptions and causing airline disruptions. Rates were up about 14 to 15% over 2019 levels. So the average rates that the guests were paying who did travel were up significantly. But in many markets, there was just so many challenges with weather disruptions that particularly in the last week of the year, occupancy fell off a little bit.
Hey, John, how do things feel? I mean, we keep saying that everybody wants to experience and get on planes. I traveled before the holidays for the first time, and I can't remember when. Is it true that you feel like there's a lot of demand out there, that people, pent-up demand, if you will, or are things starting to maybe level off a little bit?
You know, that's a very good question. I think that there may be a slight leveling off. But when you hear some of the economic news, like you were just running through,
yeah,
you might expect that the fall off would be worse. I think that that despite rising interest rates, a lot of people who are traveling today have fixed interest rates that they locked into some time ago, and their incomes haven't changed dramatically. And the importance of travel and the importance of experiencing new things is just so ingrained, particularly in the American public, that it feels like people would maybe go out to dinner, one less night a week, or forego some other expenditure to make sure that they do take advantage of the opportunity to get out, travel, get some new experiences. So we continue to see pretty strong travel trends where our group.
We're speaking with John Murray, President and CEO of Sonesta International Hotels Corporation. John, I want to make sure we have you. Can you hear me? We're going to work to get John back with us. Once again, John Murray, President and CEO of Sonesta International Hotels Corporation. One thing I want to talk to him about, Carol, again, we go back to our conversation with Michael Halen from Bloomberg Intelligence earlier today, the franchise model. And to what extent that model kind of insulates from profit margin issues at individual properties that are franchised. Because if you think about it, if they're getting a portion of top line revenue, then that's certainly a good thing. And if these hotels are feeling squeezed on the margins when it comes to higher costs for employees, higher costs for actual food and beverage that they're serving at their hotels, then Sonesta could be in a good position.
Yeah, that's a really good point, and you got to remember that when you're looking at a different property, is it franchise or is it complete ownership? We are talking, as we mentioned, with John Murray, President and CEO of Sonesta International Hotels Corporation, still with us via Zoom from Newton, Massachusetts. Zoom sometimes gives us a little bit of problems, anything virtually. But John, we're glad we were able to reconnect here. I mean, you're someone who understands this industry, and I do wonder. When you look at the next 12 months, you guys have to plan, you have to think about investments. Are you feeling confident enough to make maybe investments or move ahead on different initiatives, or do you feel like it's kind of a wait and see mode?
That's a great question. We've, we earlier this year, we acquired 4 hotels in New York City. So we're definitely bullish on investments. We're looking at a couple of markets, in particular for Sonesta, where we don't have as big a presence as we think we should, and that being Miami and Los Angeles. And so we are closely watching opportunities there. But with the run-up in interest rates, it is very challenging to come to a meeting of the minds with sellers over, if you're a buyer, on what the right valuations are. So I think it's going to be a very choppy next 3 to 6 months on, while we try to find, sort of price discovery, if you will.
What's the portion of hotels, properties that Sonesta runs as corporate run locations versus franchise locations?
Yeah, so we have approximately 1,200 hotels, and about 250 of them are managed by Sonesta.
So are you trying to grow the franchise business more right now, or the business that are managed by you?
Well, we're trying to, we're actively growing our franchise business. We just expanded beyond North America into Latin and South America and the Caribbean. We also have some other international business in Egypt, and we're expanding our franchise relationships there. But we also are trying to grow the existing hotels and take on management contracts as owners see how we're doing at other hotels, like our hotels in New York City. So I would say over the next few years, though, the expectation should be that more of our growth will come from franchising than from management.
It was interesting, John, you talked about, the acquisition of properties here in New York City, and you're looking at others in Miami and Los Angeles, and just coming to a melding of the minds, if you will, when it comes to pricing for some of those properties. Financing, is that easy in this environment?
No, that's the biggest issue, really, is financing. The hotels, the good news in inflationary periods, the guests sign leases for one night, right? So you can continue to raise rates if prices continue to go up, and so you can better protect your cash flow. But on the other hand, the fact that guests could technically all check out is very scary to the lenders, and so this is an environment where they become more cautious about where the possibility of costs increasing faster than room rates and cash flow declining, and so it's a much more challenging environment for debt financing.
It's the idea that guests could all check out at the same time was kind of laughable until just a couple of years ago when the pandemic hit and all these businesses essentially dried up overnight. So definitely makes sense. John Murray, really glad to have you here this afternoon. John Murray, President and Chief Executive Officer of Sonesta International Hotels Corporation, joining us this afternoon via Zoom from Newton, Massachusetts.
A great thoughtful dive into the industry and what's going on. So really appreciate it. All right, you are listening and watching Bloomberg Business Week. Carol Massar along with Tim Stenevec, and this is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg's World Headquarters, I'm Charlie Pellet. Stocks snapped 2 days of losses. An up day for the Dow, the S&P, and NASDAQ. S&P today higher by 28 points, up by 0.75%. We had the Dow up 133, higher by about 0.4%. The NASDAQ Composite Index up 71, a gain there of 0.7%. Traders were weighing the concerns that Federal Reserve officials voiced during their last policy meeting against key data showing the U.S. economy is slowing. 10-year yield 3.68% and the 2-year 4.35%. Spot gold was up $16 the ounce to $18.55, up by 0.9%. Bitcoin up 0.9%, 16,815. West Texas Intermediate crude down roughly 10% in 2 days. Today we had West Texas Intermediate crude down 4.9%. That's $73.14 a barrel. Natural gas today up 4.3%, $4.16 per million BTUs. So again, recapping late day buying into the close, the Dow, the S&P, NASDAQ all advanced. S&P today up by 28, a gain there of 0.75%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thank you so much, Charlie Pellet. Bloomberg Business Week is brought to you by Innovation Refunds. Your business may be eligible to receive a payroll tax refund. The application takes around 8 minutes. That's 8 minutes or less to see if your small to medium-sized business may be eligible for a refund of up to $26,000 per employee kept on the payroll during the pandemic. Find out at getrefunds.com.
All right, you're listening and watching Bloomberg Business Week. Carol Master along with Tim Stanovic on this FOMC Wednesday. If you missed those Fed minutes, you can definitely go to the Bloomberg and just get an idea. But essentially, the Fed's just concerned about, an easing of financial market conditions and whether or not that makes everybody think, okay, all in, everything's okay. Fed reminding us that, they're going to raise rates still, and they're probably not going to, or they're not going to cut rates this year.
I don't know if you've heard this phrase before, Carol. Don't fight the Fed.
No, never.
No, okay. Well, it certainly seems like anytime we get any sort of good news when it comes to, inflation coming down or perhaps a little bit of weakness in the jobs market, which we haven't actually gotten, investors get really excited. But the Fed, as we talked a lot about last week, has, been repeating this mantra for quite a few months that, right, this dual mandate is what they're focused on. And right now, that part of the dual mandate that is their main focus is bringing inflation down.
Absolutely, right? And this is the thing, although and even overseas, though, we've continued to see maybe, signs of some peaking in terms of those inflationary pressures, but, still soon to tell whether we are out of the woods with it. And the other thing is, as everyone or the Fed continues to remind us that they just don't want to stop raising rates or bring in rates too soon. And then inflation kind of rears its ugly head again. Right,
the problems of the 1970s, for example. And Carol, I think that there's the concern that there is this, I hate to use the term again, but a long and variable lag as to what Fed policy does for that showing up in the actual economy. So
it takes a while.
It does take a while, and it's going to take a long, sustained progress to actually show that it's working, and, they can kind of cool it when it comes to rate hikes.
In the meantime, we continue to really track metrics about working from home, getting back to the office. You reminded us of some great New York City subway data, right? I mean, if you get on the subway, it definitely feels more crowded. Yeah.
And, it's because there are fewer trains also running than there were during pre-pandemic. But it's not just you. The subway is actually getting more crowded. The MTA said last month that ridership hit a post-pandemic high of nearly 4 million. You can see that on the Bloomberg terminal as well. We're still a far cry, though, from more than 5.5 million riders who rode each day pre-pandemic. But the trend, Carol, is moving in the right direction.
All right. So are people actually going back to the office, and what does 2023 have in store? We've got a great voice on that. Mark Ahn is chairman of Castle Systems. It's a company that provides security services for office space here in the U.S. Think about swiping your badge when you go into the office. It's a great metric and way of measuring. Mark is with us via Zoom from Washington, D.C. Mark, Happy New Year. Nice to have you here. On Bloomberg, how does the outlook look? Are people back in the office? What does it tell you?
Yeah, well, first of all, thanks for having me. Great way to start the new year to talk about this. So look, I think we do have to keep this in perspective. From the beginning of 22 to the end of 22, the average utilization of office space nearly doubled. We started the year in the mid-20s and we ended the year near 50% on a national average. So while sometimes it feels like it's not fully back to normal, it was a huge increase last year, and there was a meaningful increase after Labor Day. And so that's what the data shows. We also have noticed over the last several years since the pandemic started that employers generally use big calendar events to put stakes in the ground and ask people to come back. And consistently, the two biggest have been Labor Day and New Year's. And we know from talking to our clients and users of office space that use Castle that a bunch of the companies that have had policies wanting people to come back, if not all the time, at least some of the time, are starting to enforce them more strongly. And many of them use the beginning of the year after New Year's as a stake in the ground. And so we did see a meaningful increase last year, and we think that you're going to continue to see a meaningful increase as we start 2023.
I'm looking at the Castle Back to Work Barometer average available on the Bloomberg terminal. Just type in KSL BWA1. And I got to tell you, it is looking like it is a far cry from where we were right before the pandemic hit. If we look at it on the level of 100 back in March of 2020, we're right now, the highest we've been is close to 50 at one point, Mark. So and that was just a few days ago. So a few weeks ago, I should say, in December, end of November. So do you think we get back to pre-pandemic levels?
I don't think we get back to 100% if 100% is the pre-pandemic baseline. I think you need to go one step deeper and to continue sort of where I'd left off. What you do notice, though, when you look at days of the week, is that on certain days of the week, namely Tuesdays, Wednesdays, and Thursdays, the occupancy is meaningfully higher and it's meaningfully lower on particularly Fridays and Mondays. And so when you go a level deeper, what you see is that, well, what you just quoted were the averages across the week, but on a national average on Friday, it's 33%, whereas on a national average on I think it's Tuesday or Wednesday, it's roughly the same, is 55%. But some markets, like in Texas, those numbers are now in the 60s and 70s on the high days. So what's clear is that people are using office space differently. It's less consistent across a week. The spread in the low day to the high day on the national average went from 9% at the beginning of 22 to now 22% at the end of 2022. And so I think you have to look at it in that lens. That I think what you're going to see is on the peak days, you're going to continue to see an increase. The Fridays and Mondays are probably going to lag, and that's going to keep the weekly average down pretty meaningfully.
All right. So Tim and I are in here Monday through Friday, and we're working on weekends too when we need to. Having said that, so what do you think about this? Yes, work from home, or we have to be flexible. Is there something that's sticking coming out of the pandemic that you think will stick forever, or do you think time will tell? Especially if especially if the economy cools a little bit.
Well, exactly. Look, there has been this ongoing sort of tension or battle, probably too strong a word, between employers and employees. Business leaders have wanted to get their people back at least some of the time pretty consistently for a while. And there's not one size fits all for companies or even within companies, but generally leaders have wanted to get the benefits of collaboration some of the time. Until sort of mid this last year, a very tight labor market and a roaring economy did not let them basically get their way. But as the labor market has meaningfully cooled off, and every day there's headlines of layoffs, and as the economy has also made business challenges greater, and therefore feel like they want to have maximum productivity, what you're seeing is the business leaders are now being much stronger in imposing come back to the office some of the time. And so that's why we think you're going to continue to see this increase as you mentioned, the economy cools and the labor market tightens.
Mark, I'm curious. So you can track, people coming in and out of offices thanks to those security badges. Can you also track how many badges are no more? In other words, churn, people leaving. Can you give us an idea, or people being let go?
Yeah, we don't have that. Maybe I will have to see if we can get it. We don't.
Good question, Carol Master.
But look, there is another point though, which is that the data pre-pandemic included a bunch of companies. There are a bunch of companies who said, I'm going to go fully remote or I'm going to downsize. And so, but they couldn't do that. They couldn't give up the office space and make it available to new tenants who by definition are going to use it if you sign a new lease until the lease runs out. So the other thing you're going to see is a recycling of space with people who did not come back post-COVID, and hopefully it gets replaced by people, well, will get replaced by people who are using the space. And so you're also going to see that over time, which again should lift the average over time. But I don't think we're going to see 100%.
Are you seeing in your experience more and more over the last year or so of, okay, these are the days that you're required to be in? You said Tuesday and Wednesday are kind of interchangeable when it comes to 55%, but do you think we'll get to a point where they're like, okay, Tuesday, Wednesday, Thursday across the board, these are the important days to be in the office, Mark?
I just got about 30 seconds.
Yeah, and that's pretty much what has happened right now. Some companies mandate the days because they feel like I want everyone back on the same days. Other companies have more flexibility, but it makes sense. The middle of the week is where most of the activity is focused.
All right, but 55%, not 90.
55% across the country. It's in the 70s in Texas, and it's lower in sort of California and Northern California. So again, that's a national average. In Austin, Houston, and Dallas, some places are over 70 and some are right about 70. So there's real regional differences as well.
Really cool stuff. Great data to break it down, and you guys obviously are seeing a lot. Mark Ein, he's chairman of Castle Systems. As we said, they provide security services for office spaces here in the United States, joining us via Zoom from Washington.
I think he was working remotely. Is that right?
I think he was working.
I think he was working remotely today.
He's smiling. I can see him on Zoom.
Let's get on world and national news. For that, we go to Nancy Lyons, who is in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Conservatives opposed to Kevin McCarthy for Speaker are not budging. A group of about 20 hardline Republicans has blocked McCarthy from being elected Speaker after 6 rounds of voting. Congressman French Hill tells Bloomberg they've been listening to those 20 behind the scenes.
This is not a uniform group of people with a uniform set of ideas. And don't forget, a majority of the Freedom Caucus supports a Speaker McCarthy.
Again, Congressman French Hill. The mastermind of the Varsity Blues scandal received his sentence today. We get details from Bloomberg's Jill Schneider.
Rick Singer, the architect of the scandal in which wealthy parents paid bribes to get their kids into elite universities, was sentenced to 3.5 years. Federal prosecutors had sought at least 6 years. Singer had asked to be sentenced to a year's home confinement, 3 years of supervised release on probation, and 750 hours of community service as recognition for his acceptance of guilt and, quote, extensive cooperation. Singer apologized during the hearing, saying, quote, I am responsible for my actions and my crimes. I did all of it. Jill Schneider, Bloomberg Radio.
California's getting ready for a major storm that could bring floods and strong winds. The state's Natural Resources Secretary, Wade Crowfoot, says it's not a time to take chances.
Stay dry, stay safe, and stay at home if possible. During the height of these storms, the safest place to be is off the road and at home.
Crowfoot says they're also expecting power outages. The FBI is upping the reward for anyone who can give them information about the pipe bombs placed at the DNC and RNC before the Capitol riot nearly 2 years ago. It now comes out to about $500,000. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. We begin with a developing story and a headline from the Bloomberg Professional Service. The House will adjourn until 8 o'clock as Kevin McCarthy fails in the latest speaker vote. We will have more coming up on Sound On, which kicks off just about 20 minutes from now. It was an up day on Wall Street, a choppy session buying into the close with the Dow, the S&P, and NASDAQ managing to snap 2 days of losses. S&P up 28, higher by about 0.7%. The Dow was up 133, up 0.4%. NASDAQ up 71 today. That was a gain of 0.7%. 10-year yield 3.68%. The 2-year 4.35%. Spot gold up 0.8%, $18.54 the ounce, and West Texas Intermediate crude declined 4.9% to $73.19 a barrel. Stocks ended today's session with gains as traders weighed the concerns Federal Reserve officials voiced during their last policy meeting against key data showing the U.S. economy is slowing. Liz Young is head of investment strategy at SoFi, and right here on Bloomberg Business Week, she told us you better believe the Fed.
What we heard from the Fed again is the same thing that we keep hearing, and I don't know why people are hoping that they're going to change their minds, because the data has not shown them that they should change their minds. So we are going to continue hearing from them that they intend to fight inflation. They intend to raise rates up to a point that is probably close to 5%, and that they don't intend to cut rates in 2023.
Meta, Amazon, Alphabet, Match Group, and Snap all initiated with buy recommendations today at New Street Research. Today, Meta was up 2.1%, Amazon down 0.8%, Alphabet down 1.1%, Match Group up 2.9%, Snap surged 5.1%. Recapping, S&P up 28, up by about 0.75%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
Bernie fed on being the guy.
They always wanted to please everybody. They didn't want to kill the goose that laid the golden egg.
And the choice he made was he could live with himself as a liar much more easily than he could live with himself as a failure.
All right, everybody, that is a trailer from a new Netflix documentary. It is out today. It's about Bernie Madoff, as you might have guessed. It's entitled Madoff, the Monster of Wall Street. It was nearly 14 years ago that Madoff pled guilty to 11 felony counts against him, securities fraud, money laundering, and perjury. And I got to say, Tim, we talked about this yesterday. For some, seeing Sam Bankman-Fried walking into the courthouse in Lower Manhattan yesterday, charged with fraud as well, easily brought back some memories of Madoff. Not apples to apples, but nonetheless kind of took us back there.
We've certainly over the last few weeks heard those comparisons. Well, someone who's talked with Madoff after his massive Ponzi scheme was uncovered and before he did pass away in 2021, of course, is Jim Campbell, host of the nationally syndicated radio show Business Talk with Jim Campbell, also the author of Madoff Talks, uncovering the untold story behind the most notorious Ponzi scheme in history. Jim is included in the new Netflix documentary and joins us via Zoom from Greenwich, Connecticut right now. Jim, good to have you with us. Really good to have you with us this afternoon. Why do you think, more than a decade following this massive crime, there still remains so much interest in it?
Yeah, well, first of all, thank you, Carol and Tim, for having me on. And first off, there's interest because FBF happened to go down right before the documentary comes out. There are a lot of similarities. But, at the heart, this is an age-old, simple morality tale. Why would a guy who was brilliant, who had a legitimate business worth at $1.3 billion, build simultaneously the biggest single criminal enterprise on Wall Street through this Ponzi scheme over 40 years?
You're talking about Madoff right now, just for clarification.
I'm talking about Bernie. Yeah, and it's the kind of Shakespearean drama that has always enraptured people. And again, here's a guy who betrayed his own sons, who betrayed his wife, who betrayed his Jewish community. 85% of the victims were Jewish or charities, something that's a sacrilege within the Jewish community to rip off a fellow person of the Jewish faith. And it's literally that kind of a story. And SBF brings similar kind of hubris, that he built this thing and somehow vaporized overnight $32 billion of market value because his dog ate his homework, which doesn't even work in 5th grade. And then you find out, no, rather, it's a pretty sophisticated fraud as well. And people are just always enraptured by something they initially trust. They may not understand it, but they believe in it. And then they find out it's all fake.
Well, it's interesting as we talk about Sam Bankman-Fried and FTX, Jim, and I think about Madoff. Like, what happens, do you think, having had conversations, right, and a lot of correspondence between yourself and Bernie Madoff, what is it that happens? Do they set out as true and ethical individuals on a mission, and then something goes terribly wrong, and they think they're going to truly catch up, and they just never do?
That's a great question, because it's what you think could be the only explanation for Madoff. And he gave me a story like that. Jim, I'm running this great legitimate business, which it was, and it was very ethically run, never screwed its clients, always got them the best price in his market making business. So you would think, something happened. I lost some money like a gambler. I'm going to double down. We'll do a little Ponzi. No one will ever notice when I get it back. But here's the thing. He's running simultaneously to this business worth $3 billion in and of itself at the peak. He's building on the 17th floor, 2 floors below, behind locked doors, with ancient technology and high school graduates, this Ponzi scheme at the same time. And in Bernie's case, the psyche is not so much greed. It's that I've got to be the go-to guy. I've got to be the guy that everybody turns to. I've got to deliver. In fact, like many narcissists or sociopaths, and Joe Berlinger, who is the director of the Netflix, has spent his time with Jeffrey Epstein, Ted Bundy, these kinds of folks, and he sees a similar lack of empathy, the lack of remorse, the narcissism, and it's at the heart of this. SBF, I think, also believes that he's a fundamentally altruistic guy. He was in that altruistic effect, and yet you look underneath what was going on there, and there was a lot of fraud. And the worst thing you can do on Wall Street is commingle client money with firm money, which on the street is stealing their money.
We should note that Sam Bankman-Fried has pleaded not guilty and is still awaiting trial, which we anticipate will happen come October of this year, Carol.
Right, and I should note I was quoting from the allegations in the charges.
Hey, one thing I think is interesting too, that once again though. Jim, we have oversight systems, big financial systems, that were certainly in Bernie Madoff's case, at some point you wondered, didn't somebody say, isn't this too good to be true? Even Samuel Bankman-Fried, I felt like there was a whole investment community that just wanted to buy into it and didn't want to, FOMO in many ways. Do you blame the system too, the infrastructure that's out there?
I would say that this was a complete systemic failure.
Which one, SBF or Madoff, or both?
Well, there'll be a little about both. I'll get to SBF, but in the case of Madoff, the SEC had 5 different shots at him and never uncovered the Ponzi scheme. In fact, they kept reinvestigating him for what they cleared him of, and he clearly had a tremendous level of trust that he captured with the regulators and his investors. I never found people who understood what his strategy was, this split strike conversion that's actually conceptually very simple and therefore totally implausible, that it would mirror the market to a 95% correlation and yet never went down. Makes no sense. SBF sent $73 million to politicians, 92% of whom were Democrat, and he had on his payroll as consultants ex-CFTC, who is, as you know, the Commodities Futures Trading Commission that has oversight power. So you have regulatory capture here by 2 guys that built great reputations, which is a similarity, and the system failed. On the hedge fund Wall Street side, these feeder funds, remember, they feed their money to hedge fund managers. Their only job is essentially due diligence. This guy is real. This matches your portfolio. Boom, we put the money there. He passed all of his fees on to them. In return, they weren't allowed to do any due diligence. That's a huge abrogation of fiduciary responsibility.
Well, we are so grateful to have some time with you, Jim. We have run, though, out of time, but so appreciate you weighing in. Jim Campbell, host of the nationally syndicated syndicated radio show Business Talk with Jim Campbell. His book, Madoff Talks, Uncovering the Untold Story Behind the Most Notorious Ponzi Scheme in History. Check out the new Netflix documentary as well.
It is 4:53 on Wall Street. Charlie Pellet with a look at today's company headlines. We begin with a headline from the Bloomberg Professional Service. J&J's consumer health company Kenvue is filing for an IPO. GE's former medical equipment business climbed today in a volatile trading debut as investors got their first chance to bet on the now independent company. Shares of GE Healthcare Technologies did advance today. Peter Arduini is president and CEO of the company, and he spoke today with Bloomberg Television and Radio.
You know, we're one of the very few companies that's in the space that can really actually make a difference in the aggregation of data within healthcare and the delivery of it. We touch many aspects of healthcare because of our diagnostic imaging background, from cardiology to oncology, and it's evolving very quickly. I think, you know, artificial intelligence is fundamentally changing how we make images, how we actually perform. And it's also then evolving into how we can bring data together to drive better diagnosis. And we're in front and center.
And today, GE Healthcare Technology shares rallied by 8%. GM has reclaimed its crown as the top seller in the U.S., boosted by steady demand and a rebound in fourth quarter production, even as higher financing costs flash a warning sign for 2023. Today, shares of General Motors did advance by 2.6%. Toyota down 0.8%. We'll hear from Ford tomorrow, up 2.8%. Those are the company stories we're following this hour. I'm Charlie Pellet. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovec and Carol Masser. We're live in the Bloomberg Interactive Brokers studio in New York City, but let's go to Washington, D.C., to our 99.1 newsroom, where we find Nancy Lyons. Hey, Nance.
Thanks, Tim. Republicans are still unable to reach any consensus on Kevin McCarthy as Speaker of the House. They've taken 6 votes over the past 2 days, and McCarthy continues to come up short. They're now taking recess and coming back tonight. President Biden is touting his federal infrastructure victory, and he went to Kentucky today, where a major bridge linking that state with Ohio is being reconstructed using those funds.
The president was joined by governors and senators from both parties in the 2 states as he lauded the result of finding common ground.
We can work together. We can get things done. We can move the nation forward. We just drop a little bit of our egos and focus on what is needed in the country.
The president singled out for praise Republican Senate leader Mitch McConnell for his key role in getting the infrastructure bill passed with bipartisan support. In Washington, Irv Chapman, Bloomberg Radio.
The Buffalo Bills say safety Damar Hamlin is showing signs of improvement but remains in critical condition as he recovers from experiencing cardiac arrest on the field during Monday night's game against the Bengals. NFL executives today discussed the medical response, and Executive VP of Football Operations Troy Vincent became emotional.
There's no playbook for managing like real-time drama and emotions associated with immediate.
Wanted you to hear this too, because you're my nephew. So I
life-threatening
screamed
Vincent
to me
says the
night,
league's
"Hey, Will, I
emergency
wanna be an
action
actor,
plan
man. I
was
wanna be an actor
executed
just
to
like you."
perfection.
You know, usually people say
The
stuff to
mastermind
me
of the
like that. I'm
nationwide
like, yeah,
college
man,
admissions
you know,
bribery
just give an
scandal has been
encouraging
sentenced to 3.5
But I was just
years
sitting
in
here thinking,
prison.
and it dawned on
Prosecutors
me,
were seeking 6.
99%
Rick Singer told the court ahead of his
people that say
sentence
stuff like
that he was
are
sorry
not
and he was
willing to
ashamed of
do what it
himself.
takes to make
Global
their
News
dreams come
24
true.
hours a
The
day, on
Marines
air and
have a
on
saying,
Bloomberg Quick
everybody
Take,
wants to
powered
go
by
to
more than
heaven,
2,700
but nobody wants to
journalists
die.
and analysts in more than
And that's just
120
real. At the
countries.
center of
I'm Nancy
bringing
Lyons.
any
Back to
dream
you, Carol and
into
Tim.
Thank you so much, Nancy Lyons. Bloomberg Business Week is brought to you by Innovation Refunds. See if your small or medium-sized business could be missing out on an opportunity. Was your business impacted by COVID-19 in 2020 or 2021? It may qualify for the Employee Retention Credit. The professionals at Innovation Refunds can help your business recover from the pandemic. See how much could be waiting for your business. GetRefunds.com.
All right, Tim, I've already seen the SNL opening skit. It's the year 2053. Kevin McCarthy is 87 years old. They're on their 2,467,565th vote for him to be House GOP leader.
I guess that means his successful elections for Republicans over the next few years.
I guess so, right? Joe Matthews coming up. He's got a lot to talk about on this second trading day of 2023. He's, of course, host of Sound On Bloomberg Radio. He's been a busy guy, certainly covering all the news out of D.C. Early on in the year. Kevin McCarthy, make it 6, and he still can't pin it down.
6, amazing 6, and more to come. That's a cold open, I presume, on SNL this weekend. I've never heard so many references to Groundhog Day on the floor of the House.
Wow.
But look, we're essentially where we were yesterday. You know, a new foil has been brought about. The name is Byron Donalds, who actually got 20 votes of the Republicans. They'll keep finding someone other than Kevin McCarthy, but they just adjourned, and they're going to come back at 8 o'clock.